Welcome to this video on the Current Expected Credit Losses, or CECL, methodology. This video is designed to provide directors and trustees of banks with an overview of how to establish appropriate allowances for credit losses, or ACLs, using the CECL methodology.
In this video, we'll provide an overview of CECL. We'll compare the CECL methodology to the incurred loss methodology that was previously used to determine a bank's allowance for loan and lease losses, or ALLL. We'll talk about items to consider when estimating a bank's ACL, including methods bank management can use. Finally, we'll briefly review the board and management's responsibilities pertaining to CECL and the calculation of the ACL.
The Financial Accounting Standards Board, or FASB, issued the Expected Credit Losses Accounting Standard in June 2016 through Accounting Standards Update 2016-13. This update added Accounting Standards Codification, or ASC, Topic 326. This accounting standard introduced the CECL methodology for estimating the allowance for credit losses. All banks that have not already adopted CECL are required to implement CECL in their fiscal year beginning after December 15, 2022, although early application is permitted.
This accounting standard is based on expected credit losses rather than incurred credit losses. The bank recognizes its estimate of expected credit losses for the life of financial assets held at the reporting date as an allowance for credit losses. In addition to loans held for investment, CECL applies to held-to-maturity debt securities, net investments and leases, and certain off-balance sheet credit exposures. Essentially, CECL includes all financial instruments measured at amortized cost. This means that when a bank adopts CECL, there may be allowances established for assets other than loans. When similar risk characteristics exist among a pool of financial assets, the ACL is measured collectively for the entire pool of financial assets. For financial assets within the scope of CECL that do not share common risk characteristics, expected credit losses are measured individually.
Items outside of the scope of CECL include available-for-sale debt securities, financial assets measured at fair value through net income, including those for which the fair value option has been elected, loans held for sale, and trading assets. Note that ASC Topic 326, which is the credit losses standard, changes the accounting for credit losses on available-for-sale debt securities. However, that is outside of the scope of this video.
So what makes CECL different from the incurred loss method, which is the previous method used to estimate the allowance?
As we mentioned, CECL is based on expected losses rather than incurred losses, which was the basis for the ALLL. Under the incurred loss methodology, the ALLL was calculated using a probable threshold and an incurred notion. In contrast, the ACL, calculated under CECL, is an estimate of the expected credit losses over the life of the financial asset. Furthermore, under CECL, there is consideration of not only past events and current conditions, but also reasonable and supportable forecasts.
The timing of when a credit loss is recognized is also different under CECL. Banks recognize an estimate of the total expected lifetime credit losses at the time of origination. For example, under CECL, in the period when a loan is originated, the bank will record an amount for the expected lifetime credit losses on the originated loan. Under the incurred loss methodology, a credit loss provision would have been expensed when it became probable that a credit loss had been incurred. So in thinking about this, the total amount of net charge-offs on loans would not change between the incurred loss methodology and CECL. The timing of the actual charge-off of an asset also does not change. That is, charge-offs would continue to be recorded when amounts are deemed uncollectible. Rather, the timing of credit loss provisions changes.
Instead of the incurred loss method of recognizing a credit loss when it is probable and incurred, CECL requires an estimate of the entire expected credit loss to be recorded at the time of origination and then adjusted over the life of the asset as facts and circumstances change. This is because bank balance sheets are expected to reflect the net amount that is expected to be collected. The net asset amounts on the balance sheet will reflect the amortized cost after expected credit losses.
Collateral dependence was a concept relevant under the incurred loss methodology that remains applicable under CECL. However, the collateral dependent definition has been altered slightly. Under the incurred loss methodology, the definition of an impaired loan that is collateral dependent states that repayment is expected to be provided solely by the underlying collateral, which could include repayment from the proceeds from the sale of the collateral, cash flow from the continued operation of the collateral, or both. Under CECL, the definition of a collateral-dependent financial asset is a financial asset for which the repayment is expected to be provided substantially through the operation or sale of the collateral when the borrower is experiencing financial difficulty based on an entity's assessment as of the reporting date.
As is the case under the incurred loss methodology, the CECL methodology does allow banks to use the fair value of collateral method to measure expected credit losses on collateral-dependent financial assets as a practical expedient. However, for regulatory reporting purposes, a bank must continue to use the fair value of collateral method for determining the allowance for credit losses for a collateral-dependent loan that is held for investment.
Let's talk now about some considerations regarding how bank management estimates the ACL. Bank management has flexibility in measuring expected credit losses. However, the balance of the allowance for credit losses should reflect a risk of credit loss even if that risk is slight, show expected credit losses based on the contractual life of the assets, and consider historical loss experience, current conditions, and reasonable and supportable forecasts.
As we mentioned, assets are evaluated on a collective basis if they share similar risk characteristics. Some examples of risk characteristics that could be used to evaluate assets include internal or external credit scores or credit ratings, risk ratings or classifications, financial asset type, collateral type, size, effective interest rate, term, geographical location, industry of the borrower, and vintage. Keep in mind, ASC Topic 326 does not prescribe a process for segmenting financial assets for collective evaluation. It's up to management to establish appropriate pools and to evaluate those pools on an ongoing basis.
If a financial asset does not share similar risk characteristics with other assets, expected credit losses for that asset should be evaluated individually. Individually evaluated assets should not be included in a collective assessment of expected credit losses.
There are several methods available for bank management to use for estimating ACLs under the CECL methodology. We're not going to cover any particular methods in detail in this video, but there are key items that we want to mention regarding any method that is used.
First of all, any method used is a starting point. Bank management will need to make necessary qualitative factor adjustments and evaluate the overall result to determine the final ACLs. Further, the FDIC does not require or prefer that banks use any specific methods. Likewise, ASC Topic 326 does not require the use of a specific credit loss estimation method for purposes of determining ACLs. This means various methods may be used to estimate the expected collectibility of financial assets. However, the accounting standard also stresses that whatever methods a bank chooses should be applied consistently over time. Keep in mind that the same loss estimation method does not need to be applied to all financial assets. Management can select a different method for different asset types or for the same asset type when that method will result in a better estimate of ACLs. Note that there is no one method that is appropriate for every bank. For example, acceptable methods include loss rate, roll rate, vintage analysis, discounted cash flow, and probability of default and loss given default methods.
Let's talk a little more about qualitative factor adjustments that management would need to make regardless of the method used. Estimating ACLs would consider all significant factors relevant to the expected collectibility of the bank's financial assets. Typically, management would begin the process for estimating ACLs by determining its historical loss information, or a proxy to historical loss information if data is not available. However, historical losses in and of themselves would not generally form a sufficient basis for determining appropriate ACL levels. This is where management would apply qualitative factor adjustments. Qualitative factor adjustments would capture information not already considered in the loss estimation process, and they could result in increasing or decreasing management's estimate of expected credit losses.
Some of the qualitative factors that management may consider include the nature and volume of the bank's financial assets, the existence, growth, and effect of any concentrations of credit, the volume and severity of past due or adversely classified assets, the value of underlying collateral for loans that are not collateral dependent, the experience, ability, and depth of the bank's lending, investment, collection, and other relevant management and staff, and actual and expected changes in international, national, regional, and local economic and business conditions and developments in which the bank operates.
No matter what methods bank management uses, qualitative factors would be a part of ACL estimation.
Now, let's shift our focus to board and management responsibilities. Bank boards and management teams have different but vital roles for this area. The Interagency Policy Statement on Allowances for Credit Losses discusses the responsibilities of boards of directors and management.
The board is responsible for ensuring that management maintains ACLs at appropriate levels, consistent with the risk characteristics of the bank's financial assets. The board will do this by overseeing management efforts to establish and maintain the ACL methodology and process. Specifically, the board is responsible for retaining qualified management to oversee ACL activities, reviewing the ACL methodology, including management's judgments and estimates, establishing and approving the written policies for the ACL, ensuring that the loan review system is appropriate for the bank's size and complexity, and reviewing management's assessments of and justifications for the estimated amounts reported each period for the ACLs.
The board is also responsible for requiring management to periodically validate and, when appropriate, revise loss estimation methods, approving the internal and external audit plans for the ACLs as applicable, and reviewing any identified audit findings and monitoring resolution of those items.
Senior management is responsible for maintaining ACLs at appropriate levels and for documenting its analyses. This means that management should evaluate the ACLs reported on the balance sheet as of the end of each period and adjust provisions for credit losses as needed to ensure an appropriate ACL level.
In addition, senior management is responsible for implementing and adhering to board-approved written policies, implementing an effective loan review system along with adequate data capture and reporting systems, conducting comprehensive, well-documented, and consistent portfolio analyses, maintaining sufficient documentation on loss estimation methods and assumptions, analyzing the collectability of loans and recognizing loan losses in a timely manner, revising and validating the allowance methodology on a periodic basis, and evaluating the allowance level at least quarterly or more frequently if necessary.
In summary, in this video we provided an overview of CECL and reviewed how the CECL methodology differs from the incurred loss methodology. We also discussed the allowance for credit losses and talked about items to consider when estimating ACL levels. Finally, we reviewed board and management responsibilities regarding oversight and maintenance of the ACLs. To emphasize a few key points that we discussed, CECL includes all financial instruments measured at amortized cost. This means that when a bank adopts CECL, there may be allowances established for other assets in addition to loans. Furthermore, under CECL, banks need to consider not only past events and current conditions, but also reasonable and supportable forecasts. Finally, there are numerous methods that can be used to calculate a bank's ACLs, and management determines which method or methods are appropriate for the bank. As we conclude, we'd like to remind you that the FDIC has additional videos and resources that can be found on the Banker Resource Center at www.fdic.gov. Particularly, we want to draw your attention to the Interagency Policy Statement on the Allowances for Credit Losses, which is the primary regulatory guidance on this topic. If you need additional information or have questions or comments, please contact your bank's case manager or regional accountant, or email the FDIC at cecil@fdic.gov, which is a dedicated mailbox for CECL-related questions. Thank you for viewing this video. We hope you found it both useful and informative.